Okay, let's dive into this. India's seeing an IPO right now that's, well, it's not just big, it's actually record-breaking in its space.
Yeah.
We're talking about the Knowledge Realty Trust. It looks like it's going to be India's largest ever REIT IPO real estate investment trust.
Right. REIT.
They're raising a huge 4,800 crore.
Wow. That's serious money.
It really is. And just for context, this isn't some small niche thing. It's the third largest IPO of any kind of asset this year. It's even bigger than the NSDL one.
Okay, so definitely making waves.
Yeah, it feels like more than just news, maybe a signal.
I think it is. And, you know, for anyone watching the markets, this isn't just another company listing.
Mm-hmm.
What's really interesting here, I think, is how these REITs, they offer something fundamentally different compared to just buying regular stocks. They're a whole different animal, really.
Exactly. So for this deep dive, our mission is sort of, let's get past the headlines. Let's really unpack what makes REITs tick, why they're interesting, maybe sometimes complicated. And we'll use this Knowledge Realty Trust IPO, this big one, as our sort of case study to understand what they are, sure, but also why they're seen as this shortcut to big real estate investing without being a landlord.
Yeah, avoiding the headaches.
So lots of people probably have a basic idea of a REIT, but let's get right to it. What's the main point? The core value, especially this rent machine idea.
Yeah, that rent machine analogy, it's pretty good, actually, because it gets straight to the key difference.
How so?
Basically, a REIT lets you, the investor, get a piece of large-scale, often top-tier real estate. Think massive office parks, big shopping malls, huge warehouses.
The kind of stuff individuals usually can't buy.
Exactly. And you do it without needing, you know, millions up front, without managing the property or chasing tenants for rent. You're buying a slice of the income that's already flowing.
People often compare it to a mutual fund, right? Pooling money.
They do, yeah. That's a helpful starting point.
Yeah.
Pooling money for a portfolio.
But it feels like the difference is much deeper than just swapping stocks for buildings. What's the absolute key thing to get when comparing a REIT unit to, say, buying stock in a developer like DLF?
That's crucial. That's where you see the real split.
Okay.
If you buy stock in a company like DLF, you're essentially betting on their business model, which is finding land, developing projects, and then selling them for a profit.
Right, the whole development cycle.
Yeah, and that comes with a whole load of risks. Getting approvals, construction going wrong, managing cash flow, trying to time the market just right for sales. It's a development and sales game.
Yeah.
A REIT, though, is different because of the rules. At least 80% of its assets have to be completed buildings that are already leased out to tenants.
80%. That's a high bar.
It is. It means you're largely shielded from that messy construction and development risk. You're buying into, well, mostly steady, predictable cash flow from existing rents. It's a shift from build and sell to lease and collect. Totally different focus.
And this isn't just how they choose to operate. It's actually built into the legal structure, isn't it? This whole rent machine thing is formalized in what's called a REIT trust.
Precisely. The REIT trust is the legal entity that holds all these properties. And in India, it's regulated pretty tightly by SEBI. That's meant to protect investors and ensure transparency.
Okay.
So when you invest, you're not buying company shares, you're buying units in this trust. And that gives you a direct claim on the rental income it generates.
Right, units, not shares.
Yeah.
It's definitely a more complex setup than just buying stock. Who are the main players making this whole thing work?
Well, it usually starts with the sponsor.
The sponsor.
Yeah, that's typically the original owner of the properties or maybe a group of owners. They're the ones who kick off the REIT by putting their existing income-generating buildings into this new trust structure.
Okay, like who's behind this Knowledge Realty Trust?
For this one, it's actually a joint effort between Sattva developers and Blackstone. They're transferring properties they own, like Sattva Soft Zone in Bangalore or 1BKC in Mumbai, into the REIT.
And they get units in return.
Exactly.
Right.
They get units in the REIT, which helps align their interests with new investors, at least initially.
You mentioned the trust holds the properties, but I've heard it's not quite that direct. There's another layer involved.
That's a sharp point. Yeah, it's a bit more layered than that usually. For legal reasons and operational ones too, the properties often aren't held directly by the main trust itself.
Oh, how does that work?
Instead, they set up what are called special purpose vehicles, or SPVs. Think of them as separate little companies, each one legally holding specific assets, like 1 or 2 buildings.
Ah, okay.
The main REIT trust then owns the shares in these SPVs.
So the trust owns the SPVs, and the SPVs own the buildings.
You got it. It sounds complicated, but it's actually quite important. It helps isolate risks. If something goes wrong with one property, it's contained within its SPV. It gives investors cleaner exposure. And yeah, one trust can hold lots of different SPVs for different properties.
Makes sense. So besides the sponsor and these SPVs, who else is key? You mentioned investor protection.
Right, two other really vital roles. First, there's the independent trustee.
Independent being the key word.
Absolutely. For Knowledge Realty Trust, it's Axis Trustee Services. Their job is non-negotiable. Oversee everything the trust does and make sure it always acts in the best interests of the unitholders, like you. It's a critical governance check.
Okay, that's reassuring. And the other role?
That's the investment manager. For this IPO, it's a company called Knowledge Realty Office Management. They're the ones running the show day to day. Meaning managing the properties, dealing with tenants, collecting the rent, and also looking for new properties to potentially add to the portfolio. They handle the operational side.
Got it. And the IPO itself, that's basically when the sponsors open the doors and let the public in.
That's a good way to put it. Initially, the sponsors own most or all of the units. The IPO is how they do one of two things, usually.
Okay.
Either they raise fresh cash by selling new units, maybe to buy more properties, increase their stake in the SPVs, or pay down debt associated with the properties. Or they sell some of the units they already hold to the public. It's a way for them to cash out some of their investment. Either way, the end result is that public investors like you get to own a piece of these big income-generating properties.
Let's talk about that income then, the cash flow, because that seems to be the main draw, and it's heavily regulated, you said.
Oh yeah, this is where the rent machine concept really comes alive. SEBI has this crucial rule. At least 90% of the REIT's net distributable income must be paid out to the unit holders.
90%.
Yep. They simply can't just hoard the cash like a regular company might. That rule is a massive difference compared to most other stocks.
So unlike a tech company that might reinvest everything, REITs are designed specifically to pass the income through.
Yeah.
How does that rent money actually travel from, say, Google paying its rent to my bank account if I own units?
It's pretty straightforward, actually. Starts with the tenant, like Google, paying rent to the SPV that owns their building.
Okay.
The SPV deducts its property-level costs, maintenance, property taxes, that sort of thing.
Right.
Then the remaining cash flows up, usually as dividends, from the SPV to the main REIT trust.
Got it.
The trust then deducts its own sort of central operating expenses, and then what's left, that minimum 90%, often more, gets distributed out directly to the unitholders, usually quarterly or semi-annually. It's designed to be a clear funnel for income.
Okay, that's clear. Now let's connect all this theory to the real deal, this Knowledge Realty Trust IPO.
Right.
What kind of properties are actually in this REIT?
Right, so Knowledge Realty Trust is what they call a pure-play office REIT.
Pure play office, meaning?
Meaning its entire portfolio is just high-end, grade-A commercial office buildings, no shopping malls, no apartments, no warehouses, just offices.
So if you invest in this, you're basically betting on companies needing premium office space.
Exactly. It's a focused bet on corporate India needing and paying for top-quality workspaces, especially in those key tech and finance sectors. It's often seen as a proxy for that part of the economy.
And the scale, you mentioned 46 million square feet. That's huge. But what about where these buildings are? Is it spread out?
Well, the scale is definitely impressive. 46.3 million square feet, 29 properties, 7 cities. But, and this is important when you dig into it, about 90% of the value of those assets is concentrated in just 3 cities.
90% in 3 cities. Which ones?
Bengaluru, Mumbai, and Hyderabad. Primarily tech and finance hubs.
So that's a key consideration for an investor, isn't it? How comfortable are you with your investment being so heavily tied to the fortunes of just those 3 city markets?
Absolutely. It raises the question of geographic concentration risk. What happens if there's a downturn specifically affecting tech in Bangalore, for example? It's something you need to weigh up.
Okay, so high concentration. What about how full these buildings are? What's the occupancy?
As of March 2025, they reported a committed occupancy of 91.4%.
91.4%. That sounds pretty good.
It's solid, definitely healthy, shows good demand for their spaces, but it also means there's still a little bit of room, maybe 8-9% to lease out, which could mean some potential upside for rental income growth. It's not completely maxed out.
And who are the tenants filling up this 91%? You mentioned tech and finance.
Yeah, the tenant quality looks pretty strong on paper. Around 75% of the rent comes from big multinational corporations. Think Google, Amazon, JP Morgan, names like that.
Okay, big global companies.
Mostly in tech and finance, yes. So again, your investment is pretty closely linked to how well these major global businesses are doing and their need for office space in India.
Is there a risk of being too reliant on just a few of those big names? Tenant concentration?
That's always something to check with REITs. For Knowledge, their top 10 tenants make up about 28.4% of the total rent roll.
28.4%. Is that high, low, average?
It's worth putting in context. Embassy Office Parks, which is another big office REIT in India, gets about 37.4% from its top 10. So Knowledge's 28.4% is noticeable. It's a concentration, but it's maybe not unusually high compared to peers in the specific sector. Still something to be aware of, though.
Okay. Now, looking ahead, are they planning to build a lot more, or is this mostly about managing what they already have? What's the development pipeline look like?
This is actually a point that suggests stability. A huge chunk, 92% of their current portfolio value, comes from buildings that are already built, leased, and generating income.
Only 8% is future development then.
Less than 10% is currently under construction or just planned for the future. So it really reinforces that lease and collect model.
So even if their future building plans hit a snag.
Exactly. Even if those plans slowed down or didn't happen for some reason, the REIT seems like it could comfortably survive and keep paying distributions based almost entirely on the assets it already has up and running. That offers a degree of predictability.
That predictability links to income visibility, right?
Yeah.
How long are these tenants actually signed up for?
Right, and that's where a metric called WALE comes in. Weighted average lease expiry.
Well, okay.
For Knowledge, their average WALE is 8.4 years.
8.4 years.
Yeah. So on average, across their whole portfolio, tenants are contractually locked in to stay and pay rent for over 8 more years.
Wow, that's quite a long time. That gives a lot of confidence in future income.
It provides exceptionally strong visibility, yes. Much more than you'd get from, say, a retail business or even many industrial leases. It helps unit holders plan, knowing that income stream is contractually solid for years to come, barring major defaults, of course.
And the actual financial numbers, do they back up this picture of a large, stable operation?
They certainly seem to paint that picture. For the financial year 2025, they collected about 4,147 crore in rent.
4,000 core, okay.
After taking out the property-level running costs, their net operating income, or NOI, was around 3,432 crore.
Still a very big number.
Absolutely. And importantly, they've shown decent growth in that rental income. Between FY23 and FY25, it grew at a compound annual rate of about 16.3%.
16.3% CAGR. That sounds pretty healthy for something that's mostly already full.
It is quite solid, yeah. It suggests they're managing things well, maybe getting some built-in rent increases from existing leases, or successfully leasing out some of that remaining vacancy.
Okay, so we've gone through the mechanics, looked closely at Knowledge Realty Trust as an example. Sounds quite attractive in many ways. But like any investment, the devil's in the details, right? What should people be looking out for?
Absolutely. You scratch the surface, and more questions always come up. Beyond the glossy numbers, you really need to dig into things like leverage.
How much debt they have.
Exactly. How much debt is the REIT carrying? Can it comfortably afford the interest payments, even if interest rates go up? That's critical.
What else?
Then there's the reliability of those distributions. That 90% payout is a rule, but how consistently can they generate the income to distribute? Are there factors that could interrupt it?
And you mentioned sponsor alignment earlier.
Yes, that's a big one.
Uh-huh.
How truly aligned are the interests of the sponsors Satva and Blackstone in this case with the public unit holders, especially down the line? For instance, if the REIT decides to buy more properties from the sponsor in the future, will it pay a fair price? Or could there be a conflict of interest?
Right, that potential for related party transactions needs scrutiny.
Definitely. So ultimately, REITs offer this unique way into real estate, sure, but they come with their own specific set of risks and potential problems. They aren't magic money machines.
As we always say, there are a million ways things can go wrong with any investment.
And REITs are no exception. The key is understanding what those specific risks are for REITs rather than just focusing on the potential upside. Knowing how they can go wrong is really your best defense.
So wrapping this up for you, the listener,
Mm-hmm.
what's the big picture? REITs and this huge Knowledge Realty Trust IPO is a prime example. Give you a different way to invest in real estate income.
Yeah, it's about owning that rent machine, which legally has to pass most of its earnings on to you.
And you get to sidestep a lot of the headaches and the big risks involved in actually developing or managing properties yourself. It's exposure to potentially steady income.
But with its own set of things to watch out for.
Indeed. Which leads us to a final thought for you to chew on. Knowledge Realty Trust is heavily betting on those big tech and finance hubs, Bengaluru, Mumbai, Hyderabad.
Right, that 90% concentration.
So thinking long term,
Hmm.
how stable is the demand from corporate India for these high-end office spaces, especially in those specific cities? If work patterns continue to shift, what does that mean for a specialized REIT like this?
What stands out to you about this model? How might its focus strategy play out if the world of work changes dramatically in those key sectors? Something to consider.